Hello and welcome to another episode of Bridging the Gap. It's me, Akshay. Our previous podcasts are focused mainly on the tax side of the WestBridge business, but the other area where we can offer vast experience and expertise is in the specialised administration of and consultancy in small self-administered schemes. I have with me today Martin Tilley, one of our directors, and an expert in such schemes.
Thanks, Akshay. Good to be here.
So Martin, firstly, what is a SAS?
Well, a SAS, or Small Self Administered Scheme, is a registered pension scheme, which means it has all of the same tax benefits of any other pension arrangement, in that contributions receive tax relief, the fund grows tax-free, and a proportion of the fund can be taken tax-free once the minimum vesting age is reached. The balance of the fund can then provide a taxable pension to the member in a very flexible way. We must also remember that a SAS is created as a trust, which means that the funds inside it will sit outside the member's estate for IHT purposes. It's an occupational pension scheme, a single trust but multi-member, most usually used by owners and directors of small and medium-sized enterprises, and in particular family-run businesses. They're particularly useful as, in addition to the full remit of conventional investments, such as funds and stocks and shares, they're also able to own commercial property which can be bought from and leased back to the sponsoring employer. They're also able to lend money back to the employer in some circumstances, meaning that instead of paying interest to a bank, the company can pay interest directly into their director's pension fund, effectively another pocket of their own wealth.
Wow, it sounds like they're very flexible compared to the usual pension scheme, which must be really attractive. So they must be quite common and widely used, mine.
Well, not as widely as you would think, considering the considerable benefits that they do offer, possibly for a couple of reasons. Firstly, the growth in the self-invested personal pension, or SIP market, which is largely favoured by some of the advisor community. SIPs became the vehicle of choice as they were perceived as being a cheaper alternative to the SAS, whilst offering some but not all the advantages. They can be cheaper for individuals, but if you have multi-member schemes, quite often a SAS should be the vehicle of choice. But with SIPs, regulation has been tightened up and they become more complex and expensive, and this has resulted in that trend being reversed, and a SAS should really be considered potentially for all limited companies. Secondly, SASs have a little bit of a tarnished name in the marketplace, as some were touted as pension liberation vehicles, where scammers claimed money could be released earlier or more effectively than the rules allowed. This wasn't the case, and those fooled into following these routes were taxed accordingly. And as the regulation of SIPs tightened, they also sometimes attracted some inappropriate unregulated investments, although most of these investment schemes have been outed now and are avoided.
So it sounds like there's been a kind of some bad publicity for the wrong reasons, and they've sort of painted the wrong picture about SASs in the past. And there's sort of similar thing with SIP. So how can trustees be sure they're not making bad decisions?
Well, really, it's down to scheme governance. The schemes operate under a trust deed and rules, and all members are trustees, and most usually decision-making is unanimous, so they have direct control over what assets they hold and also the scheme administration. In that way, all trustees should be in agreement for an investment to be made, so they are in control of their own destiny.
How can company owners be expected to understand the complexities of these types of schemes?
That's a very good question, and that's where we come in. Although it's no longer a compulsory requirement, schemes work best where there is a scheme professional with a hand on the tiller. We act as a scheme's independent trustee, sitting alongside the member trustees and working with them to make sure the scheme runs as efficiently as possible. We are there to take the burden off the members, letting them get on with the important things of running their business whilst we take care of the pension scheme. And we do this at two levels. So each scheme will have a dedicated client account manager who's responsible for all the day-to-day administration of the scheme and who will have a direct and close personal relationship with the clients. In addition, myself and my fellow director David Santony offer trustee consultancy services, often attending trustees' meetings and handling the more complex and strategic planning aspects of the schemes.
That's fantastic. So we really do offer a rounded service when it comes to administering schemes. And what role specifically are account managers carrying out?
Well, SASs spend most of their life relatively dormant, but when actions are required, the account managers need to be nimble and move very quickly. It might be that the client wants to buy commercial property, wants an update on their scheme value for the purposes of tax planning or writing their will. This is why it's imperative that the scheme records are kept up to date so that the information can be provided in a timely manner. This is what the client account manager will do.
So what does that involve and what actions are being taken on a regular basis?
Well, the basis of what we do is, of course, administration. So there are routine functions such as reconciling bank statements, might be receipt of rental payments, contributions, loan interest calculations for all the monies coming in, and of course payment of insurance premiums, payment of benefits, professional fees going out. There's also the maintenance of the asset values. Now, some asset values can be valued daily. We have view-only access on the default bank accounts, and other conventional assets such as stocks and shares and regulated funds are priced daily, so getting accurate and up-to-date values of those is not too much of an issue. Other assets like commercial property are of course more tricky. They may be more regular rental invoicing, insurance premiums to pay, lease renewals to manage, so plenty to be getting on with.
Definitely. It sounds like it's a sort of a full monitoring and managing of, administration of the scheme and sort of keeping track of, monies in and out, like you said. And then in relation to the valuing, I know that some SSASs have commercial property. Is that a popular asset? And how many of the schemes hold them?
It's a very popular asset and one of the primary reasons for holding or having a small self-administered scheme. I would suggest the majority of our schemes hold at least one property. One scheme has nearly 20. Properties, of course, are long-term hold, and we have schemes that have held the same property for over 30 years. Often these will be the property from which the business trades, where the company rent is paid directly into the scheme. Where you have a family-run business, you can see that as the business passes down a generation, it will probably remain, the property will remain within the pension scheme, and effectively the value of the property transcends down a generation as well.
Wow. So it's an effective planning tool, as you mentioned earlier. So with regard to the properties, and valuation, how often should these properties be valued? And is there an expense involved in doing that? As I'm assuming you'd need to employ a professional valuer.
Yes, you're right, Akshay. It should never be the intention to impose costs on a client that are not necessary. There are certain trigger points where evaluation is required, including vesting of retirement benefits, transfers out of members, a death or a divorce. But as an example, during the accumulation phase of a SSAS, where a client is building up their pension, there's no fixed trigger requiring a formal valuation. The property should never be retained at cost value, though, as this would probably vastly understate the total scheme value going forward. You've always got to keep an eye on total funding levels for matters of lifetime allowance, for example. At the very least, the trustees should use a best estimated value on an annual basis. And this should be the very best estimate of the member trustees, because if it's inaccurate, the only people being fooled are the members themselves. There are other reasons why the value of a property should be monitored, though. That's because of the insurance risk. Reinstatement values are often linked to capital values, and reinstatement costs must be reviewed periodically to make sure the property remains adequately insured. You'll be familiar, building costs have increased significantly recently. Cost of raw materials have rocketed, labour, etc. And the trustees have responsibility to the members to make sure the building is not underinsured.
And you mentioned earlier that a SSAS is a single trust but for multiple members. So how do you keep track of the value of each member's share of a fund?
Yep, you're right. All the assets are registered in the names of the scheme's trustees, and there is a single common fund. But we have sophisticated allocation tools which track the contributions made to each member and any transfers that come in from members' previous pension schemes, which are allocated to them. When benefits come into payment, similarly, the payments that are going out need to be deducted from their fund. So at any given point, we can ascertain exactly what is allocated to each member and prepare at least an annual statement confirming that the value of each member's share. Now, SSASs usually operate on a common trust fund basis. That simply means that each member shares in the growth of all assets in proportion to their allocated share of the fund. It is possible, though, in some instances, to earmark assets to specific members, though this must be properly documented by all member trustees so that any dispute over fund allocations can be avoided. In fact, that actually sums up our role rather well. Document and administer the scheme well, and it should run smoothly and efficiently.
That's brilliant. And well, thank you, Martin. Really interesting discussion there. A pleasure to discuss the basics of the SSAS, valuation of assets and scheme administration with you today. If any of our listeners would like to learn more about SSASs and how they can benefit you, please feel free to get in touch with Martin, David, or any of the WestBridge SSAS team.